And specifically, you guys at the Bitcoin layer spend so much more time focusing on bonds and interest rates as they seem to be telling everyone and everything what the hell's going on. So, what are you guys seeing? What are you guys paying attention to? And what is your definition of a recession?
Yeah. So there are a couple of things we're monitoring, right? Again, we sort of use rates to lead all of our discussion, but there's also a few key economic releases this week that will, as you mentioned, sort of push us closer to a recession. As of right now, CPI, the expected CPI is 8.7% year on year, and that's releasing Wednesday. And so any miss on CPI whatsoever would mean, and a miss to the upside, that'd be very bad. That'll basically give the Fed the green light to absolutely decimate the economy in terms of continuing the rate hikes, pushing for a higher terminal rate, pushing for a terminal rate that's further out. Basically, before the labor report, there was consensus in the market, and I had thought to a pretty large degree that the Fed was going to have to wrap up relatively soon, specifically because taking a look at the 2-year yield, that was coming down, and essentially, the 2-year yield leads Fed funds. So the 2-year yield is forward policy rate expectations. And so when, wherever that moves, the Fed essentially has to move. And 2-year yield, that was coming down because presumably, the rates market was telling the Fed, hey, it seems you've already tightened enough. But with the strong labor report, that basically is the Fed's first green light that they can continue hiking higher and potentially into Q1 2023 because the economy seems stronger than we anticipated. Obviously, their mandate is to kill inflation. If the CPI print comes in hot, if it accelerates year on year, those are nightmare scenarios that would basically give the Fed full steam ahead. Their runway was already extended, seeing that we have a strong labor market. A CPI miss would give the Fed full steam ahead to just absolutely plow the markets and say, all right, 3.5% terminal rate in Q1. Now we're going for 4%, right? Which obviously isn't a sustainable thing, but CPI accelerating, that's their number one concern right now. And so all eyes are on CPI really on Wednesday. And yeah, no, that's one of the big things we're watching right now, but also taking a look at rates. So as I mentioned, the 2-year yield really leads the Fed. If you take a look at a graph of the 2-year yield mapped against the federal funds rate, you can really see that when the 2-year yield falls below the Fed funds rate, the Fed is forced to pause their cycle. And as of right now, there's about there is literally right now, I have it in front of me, a 71 basis point or 0.71% spread between the 2-year yield and Fed funds. So the Fed still has 71 basis points of clearance to continue hiking. If all of a sudden the 2-year yield were to drop, pretty expeditiously, that could happen if, again, if CPI prints the way we want it to. The 2-year yield could begin its ascent back down to earth because that's the market basically saying, all right, Fed, you've done enough work. CPI is decelerating. Then that would be sort of the case for the Fed pausing, after September potentially. And then, we'll see what the 2-year yield does. But essentially, that's one of the big things we're monitoring. We're also monitoring the 10-year yield, which represents forward growth and inflation expectations. So if that's coming down, that's also the market signaling that they feel the Fed has done enough work to slow down inflation and slow down the economy. And that caught a bid in the recent couple of that's begun to sell off again in the recent couple of weeks, and the yield on that has bounced up from a low of 2.5, which we actually called over at the Bitcoin layer. We called for 2.5 a couple of months ago. It's bounced back up to 2.7 now. So potentially, again, and this is mirroring what the economy believes growth and inflation to be. If we get a CPI miss, then you could, probably see this climb a little bit higher. So we're also watching now. We're watching 5-year inflation swaps, which are inflation expectations for 6 to 10 years out. That's actually one of the instruments that the Fed watches to see if they're doing their job on fighting inflation. And those have started actually coming down in the last week. And so there are several different signals, basically all going back to this same road of, okay, if the economy is still rip-roaring hot, we got this jobs report. If the economy is still rip-roaring hot from a consumer price index inflation standpoint, then the Fed could, really put on their hats and hunker down with the hikes But that's basically all we're watching right now. You know, the 2-year yield is still trading relatively wide above Fed funds, but basically monitoring that is the most important thing to be monitoring. The relationship between the 2-year Treasury yield and the federal funds rate, that is our signal for when the Fed is going to pause. And then, you know, people are calling for a pivot, I believe, too soon. They forget that there is an intermediary phase between a hike cycle and a pivot, and that is a pause. And chances are, you know, if things play out as we believe, or as I believe, rather, I don't want to put words in Nick's mouth, but we might be looking at a pause sooner than most think. I think people are conflating a pause and a pivot. A pause is far more likely than a pivot would be. If we have this massive, awful deflationary spike, you know, asset prices get sent through the floor, yeah, you'd get a pivot. But if the economy slows down like the Fed wants it to, you get a pause and you normalize around wherever we are now, right? Wherever they end up at, like, you know, 2.75 or 3%. Long-winded, but that's essentially what we're looking at. You know, what my personal market expectations are moving into CPI on Wednesday. All eyes on CPI.